Basically, this chapter number 3, this is covering the business of insurance. And then we would like to inform you that you should be in position to understand the management of risk, insurance premium, how it is calculated, and then it will also help to understand how the insurance company is managing their risk using the reinsurance and then the contribution and how the insurance makes to society as a whole. See, basically, you should understand the risk managed by individual. You should understand the how the insurers are managing the risk. You should understand how premiums are fixed. Then you should know the reinsurance methods, how it is done, and what is the importance of reinsurance to the insurance companies. So we are going to discuss the role of insurance in economic development of the social security as a whole. Uh, so basically, you should understand the ways to manage the risk. It is already been explained earlier also, in earlier chapter also. But then, there are a couple of things will be repeated to emphasize the certain things. So basically, you should know what is avoidance or prevention of risk, reduction of risk, retention of risk, and transfer of risk. So what we have seen, we are avoiding or prevention of risk. Risk cannot be completely avoided. You see, you cannot completely avoid the risk. But then there are often, say for example, perils caused by actions of nature, actions of others. How can you avoid the risk? Somebody comes and bangs his car on my compound wall. Somebody comes and bangs his car when my car is parked alongside. You see, these are the risks which can never be avoided. Cyclones, can you stop the cyclone? Can you stop the earthquakes? No, these are the things which this is a natural phenomena and it will take place. And only thing that you should be prepared. You should be prepared by which death. Death is unavoidable. It's a matter of time. It is today or after 80 years or after 100 years or after 150 years, whatever it is. But then, as if it cannot be avoided, so you should take the precautions that what are the consequences of death that can be minimized subsequently to the family members. So this is you can avoid. Avoidance is whenever it is possible to avoid. Whenever then you should have the prevention of risk that you cannot avoid but you try to prevent it. Then there is a reduction of risk. You can reduce the risk, before and after the incidents has taken place. The incidents can be minimized. You take the preventive actions, the by which there is a reduction in the risk. Then once you have known the everything, once you have quantified the risk, you know the probability of incidents which can take place. You know the possible maximum loss. You know what is going to be the incidence of loss if this takes place for the men, money, material and machineries. Then you think of how much risk can be retained by you. It is a assess and seriousness of the risk once you consider how often it may happen, what are the extent of damages, what is the possibility of damages to environment, what is the potential damage to the safety of people. Once you consider that, then you think of retention. Once you think of retention, then it is a transfer of risk. Transfer of risk can be transferred from the individual or commercial organization to insurance company. In turn, insurance company, considering their retention capacity, will transfer it to reinsurance company. In Indian market, the entire insurance is governed by Insurance Regulatory Development Authority of India. It is controlled, totally controlled by, under control of government of India. Because you see, there should not be fraud. There should not be any unnecessarily the collection of premium and non-payment of claims. So everything is controlled by the RDI. So what is the purpose of insurance? Basically, in India, you cannot have both the business put together. Like you cannot have life insurance and general insurance put together. You cannot do both the things in under one umbrella. It has to be separate. If at all a general insurance company is issuing a policy taking care of life, the appropriate premium they must have tie up with some of the life insurance company, and they should pass on premium to them for taking further action. Because you see, the insurance company is taking a premium, then they are also reinvesting it. So they have the coffer at the time of catastrophic loss, and then considering the quantum of possibility, the losses percentage, they have to maintain they have to have the maintenance for payment of this claim. So what is the purpose of insurance? Basically, we are bringing people together. You are pulling it who are exposed to the similar type of risk. That means that is the reason they have created a different department. Life is a separate department, the separate insurance company. In general insurance also they have separate department. The fire department is separate. The machinery breakdown is separate. Contractors, all this will be machinery breakdown or miscellaneous. The automobile policies will be different. It will be handled by different people. The third party liabilities of automobile will be different. So there are similar hull and machinery, everything they are pulled together. If I only one hull and machinery, if I only one motor, you see, I cannot give justice. It will be very difficult for me to, because there is no pull. And the full concept of the insurance is based on pooling of a business. Many people of the similar risk putting together, and they're collecting the premium considering what is going to be exactly losses. So if the loss is more, the premium will be more. The insurance company, they have various portfolio. They see their overall claims ratio. There may be that, say, health department or the mediclaim department is not making a profit, but then there is other fire department may be making a profit. So overall they look at the picture. But then at micro level, one should be knowing that how much premium I am collecting under fire portfolio, hull and machinery, cargo, and what all my disbursements, how much I am paying it back. But then what is the purpose? It is basically we are bringing people together. Then we are collecting the people from the individuals and then pay the compensations, the call and claims, and then the event of losses we are paying the losses, considering this. But if there are losses are 100%, insurance company cannot function. So it is based on statistics of the losses. Based on statistics of the losses, premium or what you call money also sometimes. So premium is it's a consideration for acceptance of the risk. This has to be known that how the insurance is functioning. Basically, the insurance company is receiving substantial amounts of money from policyholders, and these funds must be managed very, very carefully to ensure that there is enough fund to pay the claims. Try to understand how insurance company is functioning. For example, the earning from premium is 50,000, and then there is the investment with various uh, places, and I am getting 20,000 rupees earning from the investment. So put together, I have 70,000 rupees in my hands. Now expenses are rupees 15,000 towards salaries and all other administrative expenses. Okay. Uh, so what happens after that? The 15,000 could be distributed towards profit, etc. I have to maintain 40,000 rupees for disbursement of claims. There would be certain claims. So try to understand whenever I am having a 70,000 rupees, including my investments and basically a premium what I am earning, and if I am paying 40,000 rupees towards claim, uh, if I start paying 70,000 rupees a claim, I cannot function. I'll be making losses. So insurance company should see what are the revenues of the insurance company, what are inflow, what are outflow, how much the insurance companies can minimize the risk by retention and by the reinsuring with the outside companies. The funds has to be managed properly. The insurance company must manage funds very, very carefully. They are not to accept any business which is not of the same kind. For example, the people already in this particular group. So that means if I am in a group where the risk is less, you cannot put a person from the circus in that. You cannot take a person who is riding motorcycle in the race. We cannot take a person who is riding the in the car racing or is in the horse racing. So all these things will have the higher risk. So you have to if somebody wants to have the insurance of a high risk people, that group has to be separate. There has to be a lot of people in that particular group wanting to take the insurance. Then I can have a separate pool for them. But otherwise, you cannot have these two different type of people together. Similarly, I have only one ship, one motor, and the entire business is of fire. No, that is not permitted, because uh, then the hull losses will be paid by the coffers from the fire policy. So what we have to see, you identify and refuse. The insurance company may identify and refuse what we call the risk which is decline, the declining risk. There are certain risks, the cargo going by sailing vessel, the cargo by wooden vessel. There are certain hazardous cargo. These things are, at declining risk. And then many times the moral hazard. There are some of the insurance. There are some of the parties. They consider the insurance. It is a way of making profit. They have a ledger in the books of account. They have a ledger profit from insurance. Basically, there cannot be any profit from insurance company. So you have to identify these type of people. Yes, there are different type of people. People wants to have easy money, the fastest money. There could be fraud, there could be cheating. So insurance company has to monitor everything. They have to see they will not pay any claim losses which are not accidental. Non-accidental losses should not be paid. So there is a social responsibility on the funds management. So all these things has to be seen. All organizations are not same. So this is very important for a participant, for a student to understand that how insurance company is functioning, how insurance company is collecting the funds, how they are minimizing their risk, how they are disbursing the claims, how much they have. Say for example, my claim ratio, the insurance company is telling their claim ratio is 110%. What does it mean 110% claim ratio? That I have earned a premium of 100 rupees and 10 rupees, 10 percentage I have paid from my investment. Now this is not the correct situation. Up to 100% claim ratio, it is acceptable, because it is expected that under social responsibility, the insurance company, if they are making a very, very great profit, that means they are trying to have higher premium from the people, which is not expected. But you look at the motor department, the claim ratio is much more. You look at the health department, claim ratio is much more. Many private insurance companies in India, they are not interested in hull and machinery business, because the claim ratios are much more. So the insurance company is also, although social responsibility, they are also in the business, they are also in the commercial world. So they take premium, they invest the amount of funds, and then they are managing the funds by which they will give it to they will also have their own expenses of salary, administrative expenses, pay for the claims, and then retain certain thing for the catastrophic funds, and then have the reinsurance considering the extent of losses. So in general, or you can summarize the things, that from where the revenue comes from the insurance company. One is premium collected. Basically, when I go to insurance company, looking at my risk, looking at my car, looking at my age, looking at color of my car. You see, in foreign market, they consider the age. A person middle age, at the age of 50, who is not having the habit of drinking. It is a safe venture than having a young boy, 18, 19, who thinks that the manliness is the driving car very fast, and he's having a peculiar color like red, etc. Dangerous color in his car. All these things are considered from the risk analysis point of it, and insurance companies fixing a premium considering the strata, the age strata, and then the vehicle type strata, whether it is driver driven, or the every family member is going to. In India, what happens? You may have one or two cars, and every family member is driving that one. The risk is more. It is that the premium is paid on the value of car, but then many places it is based on the person who is going to drive. So there is one car which is valuing say 10 lakhs rupees, and it is only if the 10 drivers are driving that one, the risk associated is different, because every person is different. So in Indian market, there is the premium is not based on the license. There is no additional, say, for third party liability. When the license are issued, nobody is taking me, say, for example, 200 rupees or 500 rupees per year. So I have to pay, say, 5,000 rupees per year, which will go to the coffer of government for the third party liability. So things are not there. But then otherwise insurance company is collecting the premium, and then there is the income from whatever premium is collected, then it is kept as an investment also. Then after considering my expenses, day-to-day expenses, administrative expenses, then the funds, I am managing the funds. I am insuring, I am also putting this money in stock, mutual funds, the interest, and then I am trying to invest in a way that I will get the benefits of my investments. I may get dividends on my investment. So this is the way, the income is from premium and also from the returns on my investments. So this is the way insurance company is having funds. The expenses, what are the expenses of insurance company? Naturally, the salary, then the commission which I am paying for bringing business to the brokers, the rent and other expenses, we can say it is the associated with the managing expenses, managing the business, or you can say administrative expenses. So these are the expenses: commission, administrative expenses, salary, etc. And then it is as a funds manager, the insurer has to be effectively manage the funds as a trustee. It is managing a common fund on behalf of its policyholder, because he is having the business is of good faith. The business is uh, you cannot, you can manage the fund. You see, there were cases, you might have heard the case of Harshad Mehta. The Harshad Mehta became, because he was managing the funds of one of the insurance company, and then he started investing on himself, and there were a couple of frauds perpetuated by him. Such thing can also happen. Of course, I'm not knowing about the frauds he has created anywhere in the insurance company, but definitely he was having the inside information about the various organizations, because they were managing funds of them. So the insurance companies are also having money in the stock market. Of course, there are government regulations informing insurance companies how to invest, how much to be invested, where you can invest. There are very strict rules and regulations on that. I have seen one of the insurance company in Nairobi. What I have seen, this insurance company was accepting the business from the Nairobi market, or you can say the Kenyan market, and 100% they were reinsuring it. They were not retaining any risk with them. They were in a way they were acting as a broker. They were acting as an agent of some of the reinsurance companies, and they were getting a commission of, say, 15% or 20% from that. All their administrative expenses they were doing. So the reinsurance, it is a very, very important function or important department in the insurance industry, that what insurance companies, they can transfer the risk from insurance company to another insurance company. It is known as a reinsurer or reinsurance company. Now, why it is done? This is to ensure that they fulfill the promise to pay the claims even during catastrophic events. Insurers are transferring a part of their risk to another insurer. See, what happens that I cannot retain every risk. So, for example, if I have a 10,000 crore risk retained with me only, and if there are catastrophic losses because of cyclone and because of any earthquake, etc., the amount of payment in one particular area, maybe it will be more than 10,000 crore, and then I cannot pay them at all. There will be a bankruptcy. To avoid all this situation, the every insurance company, they consider their administrative expenses, they consider their retention risk, they consider the how much thing can be managed by them. Other thing, it is reinsurance. Certain element of reinsurance is compulsory in India with the General Insurance Corporation, and then subsequently it will go to the different insurance companies in the market. You have the agreement with reinsurance company on regular basis, or sometimes on a one alone basis. You go to some insurance company and try to get the reinsurance from them. when it is not possibility to place the business in reinsurance pool. In India, reinsurance are compulsorily ceding what we call cede 10% of their premium to national reinsurer. The General Insurance Corporation, it is a reinsurance company of Government of India, insurance company. So we are ceding. Whenever you are giving the risk to the reinsurer, they say it is ceding part of it. So this question may be asked in your examination in MCQ. So insurers retain the risk up to certain limit, that is retention capacity and retention limit, and transfer the rest to the reinsurer. Now say for example, I have accepted a huge risk which is costing 300 crore. I do not have capacity of that. But then I know that, okay, out of 300 crore, I can maintain only say 10%, that is 30 crore can be maintained. So 30 crores I am maintaining with me. And then the remaining 10% will be, it is going to the reinsurance, General Insurance Corporation. So 60 crores are over. Now still remaining 240 crore. So this 240 crores will be placed in the reinsurance market, maybe London market or Singapore market or outside India market, it will be placed. So whenever there is a catastrophic loss or the loss is of full 300 crore, my liability will be limited to 300 crores only. And the remaining I will get it from my reinsurers. So this is the way how reinsurance is functioning. This is very, very important because it is an integral part of the insurance business. We should understand, that how reinsurance is normally arranged. So what they say, there could be a reinsurance agreement. Who is arranging the reinsurance? Reinsurance can be directly arranged without any broker with the direct contacts with the reinsurers, or it is a reinsurance brokers acting as a intermediaries. There is every possibility that when I want to place my business, you see what is happening many times. What happens that there are private organizations, there are big limited companies uh, in multiple thousands and you can say uh, MNCs, they have already very good contact with the insurance companies. They also maintain very good contact with the reinsurer. So whenever they want to place a business in Indian insurance companies, they also go to the reinsurer and then get the part of the business reinsured with the reinsurers. So there are many ways the reinsurance can be arranged. But then there are reinsurance brokers. They are acting as the intermediaries. Then there are treaties, what we call that there is a reinsurance treaty. What is a reinsurance treaty? That it is between insurers and the reinsurers. That they are arranging the reinsurance any amount above certain retention limit of the insurance company. Every insurance, say for example, if my retention limit I have maintained it as a 1 crore rupee, any risk which is above 1 crore rupee will be placed in the treaty. And then these people, when the treaties are specifying that reinsurance would be a certain proportion of the risk undertaken. Even the reinsurer may maintain the 10%, 50%, 20%, considering their agreement and understanding with the insurance companies. So there are treaties, where you have the continuous understanding with the reinsurer. It could be facultative business. My treaty is over. My treaty, the limits are over if it is provided. And one on cover, I want to go to the international market. It is the insurance in isolation. So I go to various insurance companies, either directly or through broker, and I tell them about my business and my requirement of reinsurance. And there is every possibility that I will get a reinsurer, which is a facultative reinsurance. So depending upon the terms of contract, the reinsurers may or may not have the option to refuse the particular risk. In facultative, I can say no, I am not interested. Whereas in treaty, no, it will be very difficult for uh, there is no question of difficulty. You cannot refuse having accepted the terms of uh, the uh, the insurance. And then it is a business of good faith. At least at organizational level, this is definitely maintained by the insurance companies. Apparently, this image is very, very clear. the individuals, organizations, the individual companies, the commercial organizations, they are considering the amount of risk and they are placing it with the insurance companies, and the insurance companies, uh, uh, this is the liability created, and then there is a cession, ceding of the business with the reinsurance companies. There is a basis of reinsurance, could be a treaty, it could be facultative, but then there are various reinsurance companies. They accept premium only from the insurance company and not directly from the market. So from market, through intermediaries, through brokers, through agent, it is business is placed with the insurance company. The risk is placed with the insurance company. The insurance company consider the retention risk, and they have understanding. They have treaties with the reinsurance companies, and this is the session, or what we call it. So this is also similarly a image, a schematic diagram what I am trying to show, that how reinsurance works. This is very, very important, and then try to understand. It is always good. Now we are all grown up. You see, when I was in Indian Navy in 1969, the our base INS Angre commander, base commander was uh, Commander Mahendranath Mulla. I do not know the students and participants, they have heard his name. It is a captain, he became a captain, and he was a captain of INS Kukri during 1971 war. The Kukri was torpedoed, and then he was asked to abandon the ship. He refused. He said, I am a captain of this ship, I will die. So it was a harakari, and Captain Mahendranath Mulla lost his life during 1971 war, posthumously awarded Mahavir Chakra. Why I am talking in this? I am talking of Captain Mahendranath Mulla, because when I was taking training in 1969 in INS Angre in the School of Naval Architects, I was the captain, the commander Mullah came, Mahendranath Mulla came to our school, and he said that I came to know couple of students, couple of trainees, they are playing matka. Matka is a gambling, they are playing matka. Then he said that it is the punter never wins in matka. If you want to earn out of gambling, you have to be a bookie. It is only bookie who makes profit, and then the punters never make money out of gambling. So I'm warning you, I'm cautioning you, you are not to gamble. Now, this his lecture, my age was 18, 17, 18, something like that. It was engraved in my mind that yes, I should not play gambling. I used to show the students, how cards can be rigged, how cards can be arranged, how they can cheat you. So the insurance is inverse. It is not same like gambling. The gambling, it is under control of the bookie. Whereas in the risk, it can be controlled, but it cannot be totally avoided in the insurance company, and that is the reason it is functioning, that people will place business with the insurance company. Insurance company in turn will place business to the reinsurance companies, and they are transferring risk. So they are assessing the risk, they are retaining the risk, and they are transferring the risk. There are catastrophes, say Orissa. Thousands of buildings are damaged, the cars are underwater because of floods. So you can imagine the massive, there are few insurance companies in that particular place. They are having that business, but the loss is catastrophic. So that means to avoid loss from Orissa, I should have a premium even from Madhya Pradesh and Uttar Pradesh, where there will not be any cyclonic losses the way Orissa or Kerala or Maharashtra or the sea-facing states are having. There are certain places prone for the earthquake. So when I'm collecting a premium for earthquake from the place where it is prone to earthquake, I must have premium from other places which will not have earthquake. And this is the way I'm trying to arrange, I'm trying to pool, I'm trying to take people together. And then whatever the risk I'm retaining the risk, I'm transferring to reinsurance company. This is very important thing that every participant should know how the insurance company is functioning. The next stage will come that how premium is decided, how the risk is analyzed, how to fix a statistically it is available, the premium ratio, etc. Now you should understand about the reinsurance even from the examination point of it. So what we have seen in the reinsurance, it could be non-proportional, it could be proportional, it could be facultative. The non-proportional is divided into excess of loss. Will come later on when the topic of reinsurance is discussed. Then there is a stop loss. In proportional, there are auto facultative. There is a quota share come surplus. There is a surplus. There is a quota share, and then there is a facultative. So these are the generally how reinsurance works. The reinsurance department, it is a totally separate department in every insurance company. Okay, so they are dealing only with the reinsurance. They are not dealing with the normal claims or underwriting or any other department, but their job is to take care of reinsurance. But there are different terms you should be very much acquainted. Say, for example, the ceding. They will say ceding, it is a CEDING. This is a term used when the primary insurer is passing the risk on to the reinsurer. The reinsurer accepts the business and the primary insurer here is called a ceding company. And the company that takes on the risk, it is called the reinsurer. Why these words are very, very important? Because they may be asked in your multiple choice question. This could be, what is ceding? What is the reinsurer? Then what is the retrocession? This question 100% they will ask on the retrocession and you should know about it. The retrocession, it is a reinsurer, the reinsurer with another reinsurer or insurance company. Such process of transferring is called retrocession. That means even the reinsurer can transfer the risk to another reinsurer and that is known as a retrocession. Then there are treaties. What are treaties? The treaties are agreements between the ceding company, that is the primary insurance company, and the reinsurer containing terms and conditions on which risk shall be reinsured. Such treaties or such agreements are valid, of course, for a specific period. And this can be renewed at a different terms or the same terms depending upon the experience of that particular portfolio, experience, the loss ratio. Naturally, if the loss ratio is more, the reinsurer will not be interested to keep the insurance with them. Then there is a surplus reinsurance. So these are the agreements. Basically, we should understand what is a facultative reinsurance. Now, facultative reinsurance, this is as and when the reinsurance has the right to decide whether they should accept the risk or should not. In other words, the reinsurer negotiates with each risk whether to take it or not. This may happen, this may not happen in treaty cases. This can happen even in the treaty that you are negotiating, we are discussing on each risk. And but where the risk is not within the terms of the treaty, then it will go to the facultative. So you should know what is the treaty. It is a continuous arrangement. The reinsurer may not be in position to decline the risk, whereas in facultative, the person is in position. Say for example, if I have a cargo policy, which is a sales turnover policy, where I cannot be choosy about one particular sale and I cannot decline that one. But if someone is coming with one cover, one specific voyage cover, and if I feel that no, it is going to say Somalia, I don't want to accept the risk. This consignment is going to sanction countries. I do not want to accept the risk. I can decline that one. Decline, the primary insurer will decline the risk. So in facultative, also even in the sales turnover policy, he can incorporate certain terms that it will not go to sanctioned country, it will not go to Somalia, something like this. So insurance company also considers the risk whether it is to be accepted or it is not to be accepted. What is surplus reinsurance? It is agreement required reinsurance beyond the retention limit of the primary insurer. So that becomes the surplus, the limit beyond the retention limit of primary this thing. My limit is say 50%. So above that become the surplus reinsurance. What is quota share? There is a quota share. It is a proportion of all businesses to be reinsured. Certain quota from that surplus will be reinsured. So excess of loss. Now excess of loss, what we have seen here, it is an arrangement where the reinsurer steps in only if there is a loss that exceeds the specified limit. Insurance company may have several excess of loss treaties with second and third insurers set the different limits that come into effect when the loss is in excess of that particular limit on the primary insurer and the first reinsurer. These are called the first, second, and etc. excess of loss. So there are various methods of reinsurance. It is not that simple. It is a complicated subject. But the students here, they should understand what is the concept of reinsurance, how it is done. In detail, they may not be asking you question, but at least they will know that you should know what is excess of loss ratio. When the net claim ratios of the insurer, which is exceeding the specified limit of the financial year, this is of excess of loss ratio becomes operational. What is the pool arrangement? The pool arrangement in reinsurance is also number of insurers agree to pool. All premium received and claims are paid from that particular pool. Expenses and the profits are shared as per agreed interest for the pool members. So these are very, very important aspects of the reinsurance, right from ceding, retrocession, treaties, facultative reinsurance, surplus reinsurance, quota share, excess of loss ratios, pool arrangement, one should know in details. Now this is very, very important. The role of insurance company is definitely at very higher level in economic development and social security of the personnel. So economic growth depends upon business, naturally, and the business depends upon the insurance. Non-life insurance business grows parallel to the economic growth. You see, it is something like this, that if there is a society which cannot sustain, if there is a family which cannot sustain, it is definitely affecting the overall structure of overall fabric of the nation. That people below poverty level, people above poverty level, the middle class society, but then because of untimely death of a uh, money earner, the full family is, it is in depression, financial depression. So to take care of it is a responsibility. It is a social responsibility. The insurance company insurance is provided, so there will be the family will sustain. When the family is sustaining, the society as such will sustain. And then considering so economic growth, these things are very essential parts of our family. The industry depends on insurance. Now, whenever I have a big industry, I have a ships, I have a many things, and then there is a risk associated which I cannot, in case of overall losses, catastrophic losses, I cannot manage that because I have, you see, with very great difficulty, with amount of funds which I have taken a loan from the banks, I have started a business. The payback period of that business, it is maybe 20 years, 25 years, 30 years. But then whatever I'm making profit, I'm making some profit for me, my administrative expenses, giving salary, the maintenance of my machineries, etc. But if there is a catastrophic loss and entire thing is collapsing, I may not be having that much of sufficient funds with me to restart my own business, where the insurance comes in picture. So the industry is also depending upon the insurers to manage their manufacturing and commercial risk. The general insurance is contributing to the continuation of trade by fulfilling the obligations at claim time, which in turn can prevent the businesses from the going broke. This is very, very important. The insurers collect premium, a substantial part of which is invested in various infrastructure projects which lead to economic growth. This is very, very important, because they are also insurance company collects money and they act as a fund manager. They are investing the funds at various places. So this is very important. There are social security schemes. There are various social security schemes under both, maybe life insurance company or general insurance company. This is in order to prevent the families from becoming a burden on the society. A, I have already explained that if there is an untimely death in the family, there is every possibility that the family will become burden on the relatives, on the neighbors, on the society. In the event of death of the family member, or we can say what we call is a breadwinner. So it is the responsibility of the government to take care of it. So that is the reason they have provided the life insurance schemes. Not only that, this was also taking life insurance was given as an incentive, so they were having the tax benefits earlier. You see, so all these things the government was as a social responsibility, they were looking at it that okay, you pay few amount of premium, you will get tax holiday, you will get concession from the tax what you are paying it. In India, the government stipulates that all insurance designs insurance programs for promotion of social welfare objective. This is under control of Insurance Regulatory Development Authority of India. Everything is nicely controlled. So you should understand that there is a insurance is having part in economic development. Also, it is having a part in the social security and social fabric of the government as such. To summarize this particular chapter, we can say that there are four ways in which risk is managed. These are prevention or avoidance, reduction, retention, and then transferring the risk to the insurance company, reinsurance company, and then retrocession. So there are multiple ways of doing that. The insurance spread the losses of individual over the group of individuals who are exposed to similar type of risk. Thereby, you are making the process fair, equitable to all. In other words, we are trying to say that there is a pooling of the similar type of risk, and then we are putting it together and then collecting premium, considering what is going to be a probability of losses in this particular discipline. This is also a process of transferring the risk from the insurance company to another insurance company, which is also called a reinsurance company. In India, the General Insurance Corporation, it is a national reinsurer. The difference in the insurance revenue and expenses is not treated as a profit. It is held in reserve to cover claims cost. After maintaining a reserve, the balance can be distributed as a profit to shareholders or bonus to the policy holders, because they are the member, they are the part of your insurance company in a way. The insurance premiums are based on the expectation of the loss, and insurance which is using a statistical principle, actuarial principle, such as law of large numbers to determine what is the risk associated in particular discipline. The general insurance contributes to the continuation in the trade. It is by fulfilling the obligation at claim time, which is in turn can prevent the business going broke. The underwriting is the process used to determine the entry into the group. Underwriting includes assessing the risk to determine the exposure of the group and to determine the premium which they are charging. This is very, very important